Hello, everyone, and welcome to our webinar on structuring your business for success. My name is Rebecca Nilsen. I'm a senior associate here at LegalVision in the commercial and corporate team. And I'm joined today with my co host, Alaina Smith, who's a lead accountant at Beanie, who will be able to answer all of those financial questions that lawyers hate to answer. We're going to get stuck right into it today. There's quite a few of you registered, so we're going to try and respect your time, make sure that we get into things as quickly as possible. But before we begin, we are going to just do a little bit of housekeeping. So today you'll receive the recording and slides into your email afterwards. So there's no need to worry about taking notes or trying to get copies of this. We'll send it all through to you at the end of the webinar. If you can, while we're speaking, please send through your questions into the Q&A box. We'll address as many of them as possible at the end of the presentation today. Please complete the feedback that we have after this webinar as well. That helps us make sure that we're providing really high value content for you and making sure that you're not wasting your time when you tune into our sessions. We have a poll question for you to answer today, which is about which part of structuring a business do you feel the least confident about? So those options should have popped up for you now, and you'll be able to, if you answer those, we'll be able to structure our conversation a little bit better towards who's here today. Um, Now, the other bit of housekeeping is that by attending today and being present for the webinar, or if you've signed up and received this recording in your inbox, you're entitled to claim a complimentary consultation with LegalVision. So we can help you discuss your business. To claim that, you just have to leave your contact details in that survey at the end of the webinar, and or you can contact us via our website. That's too administrative for you. All right, today we will be discussing business structuring, so common structures for your business. We'll also be doing a focus on companies and how that all works. Restructuring your business after a launch. We've already had a question pre-submitted around that, so we'll be able to talk about what happens if you need to restructure after you've started your company, as well as that Q&A, which hopefully we'll be able to leave enough time for to have some good, juicy questions in there. Alrighty. Looking at some of these results, we've got the vast majority of you are very interested in what happens with restructuring after launching. We've got a couple of questions really about setting up the right shareholding arrangements, managing the overseas shareholders and operations, choosing the right business structure, and a few of you who are all of the above or not sure here to learn. So that's really great. We'll make sure that we try and do plenty of time to talk about what happens when you restructure after you launch and making sure that those shareholding arrangements, be it overseas or domestic, are covered today. Okay, so let's get into the basics of business structuring. So, the common structures that we have in New Zealand that hopefully the majority of you present today are aware of, and if not, we'll take you through them, is a sole trader, which is generally the simplest, the first that people turn to when they're thinking about starting up a business and sort of bootstrapping themselves. From a legal perspective, it is a very easy structure to work with. It's very basic, but it's also quite high risk. It's something where you don't have a lot of protection that companies can provide you, and that can be a bit of a complication. We've got partnership, which is there's none of that registration or ongoing maintenance from a legal perspective, but it is governed by the Partnership Law Act and a partnership agreement. So there is generally some documentation to prepare before you get started into that particular type of structure. There is a trust. Now, trusts in New Zealand are highly regulated and it's an evolving space. We had huge amounts of legislation come out in 2020 with the Trust Act 2019, which affected how trusts are operated. And then your trust deed is the other governing piece that tells you what you can and cannot do. Trusts are a really interesting vehicle for business and sometimes fantastic and a lot of times not. And they require quite a sophisticated person to manage them, and you often need quite a lot of professional support for those. And then you have companies, which is the one that everybody is very familiar with. It's what the company's register has. It's what we need to make sure that we are being very careful in our governance by. And there's a whole suite of legal obligations that we need to be careful with. There's a lot of advantages to these structures as well, though, in that we have lots of protection under the Companies Act, and there's some asset protection, and the ways in which we structure your company setup can really help protect your assets as well if you're looking to do that. So we can talk about those bits in a little bit more detail in the next few slides, but I'll get Alaina to take you through sort of the bottom half of this slide, which is all about the financials of these different structures.
Cool. Thanks, Rebecca. Hi, everyone. So I'll just start with sole trader. So for a sole trader, everything is recorded through your personal IRD number. Any income that's generated is then taxable in your personal tax return at your marginal tax rate. If you make a business loss as a sole trader, that loss can be offset against other income that you have. So against interest income, PAYE, wages, that sort of thing. The only thing that can't be offset is residential rental losses now. Partnership is similar. It's a separate IRD number, separate tax return, but the profits from the partnership get distributed to the partners. And again, that income is taxable at the individual's rate at your marginal tax rate. So a partnership itself doesn't pay any tax, but again, just the personal tax rates there. A trust has its own IRD number, has to prepare its own financial statements, its own tax return. Losses cannot be passed on to beneficiaries. They are stuck within that trust and can be used against future profits that that trust makes. The trust tax rate has changed to 39% now, so it's a flat rate, all income at 39%. There is small option for smaller trusts. If your income is under $10,000, you can stay at the 33% tax rate. But as soon as you're over that limit, every dollar is taxed at 39%. So it's not looking too good from a tax perspective anymore. It's not. We've got better options. So we'll move on to the company. A company has its own IRD number, has its own financial statements, own tax return. Again, losses are kept within that company. They can't be offset or transferred to a shareholder. They can be offset against future profits made. We can also do loss offsets within company groups if there's common shareholding. So it's something to keep in mind. And a company tax rate is a flat 28%.
Uh,
Um,
and just noticing a correction on this slide as well, apologies, is under trusts, they are a separate legal entity. So there is a degree of protection on the trust against your personal, but there is very significant differences between the amount of personal liability you wear as a trustee versus a director of a company, which we can go into more detail if you need. So moving along, sorry to interrupt you, Alaina, to the marginal tax
no,
rates.
go for it. So as I said, trust 39%, company 28%, and for everybody else, this is the individual tax rates as from 1 April 2025. The tax rates changed midway through last financial year, so these are the current ones that we've got. It's a tiered system, so how much tax you pay, what rate you're on, depends on how much income you earn. Anything over $180,000 is taxed at 39%, just like a trust.
All right. A focus on companies. Everybody, when they come to us and they're talking about structuring, it's always like, should I be setting up a company? And realistically, it depends, which is never the favorite answer. But it is a separate legal personality and it's a limited liability for the shareholders, and the directors get a degree of protection. So, how much risk are you going to be taking on in your business? Do you need to separate yourself from your business activities? And do you really want to have that separate documentation setting up an entirely different legal entity that then you need to manage? Credibility can be a big part of this. People really like seeing a company with a registered company number and knowing that you're going to be adhering to the Companies Act and a lot of the rules and restrictions that are within it. and it's really well understood internationally. So domestically, I think New Zealanders are really great at understanding that you can be a sole trader running a business, and that's a perfectly valid business model. But internationally, to have that credibility, a lot of times people want to see that you're a registered entity, and companies can be really helpful for that. There's also significant growth potential. So if you are going to be looking at down the track, bringing on shareholders or doing capital raising activities, a company is a better vehicle for doing any of those sorts of activities later on, and in some circumstances, the only vehicle you can do that with in New Zealand. Um, so Alaina can talk to you a little bit more about that.
Cool, perfect. So yes, companies, like I said, it's the lower tax rate of 28% is one of the reasons why people prefer the companies so much, especially if you are earning a lot of money to try and avoid those higher tax brackets. Um, Profit sharing, so we can have multiple shareholders working within that company, and it's easy to allocate shareholder salaries out to those shareholders. You've got lots of flexibility around that, and also within groups of company with common shareholding as well. Just keep in mind things like market salaries need to be allocated. So if you do have working shareholders, we can't just allocate that salary so you're on the lowest tax rate. It has to be at a market value. Um, and there's other rules around personal services rules and stuff, which we'll touch on a bit later. And then when it comes to selling those shares, if you want to bring somebody else on board, there's no capital gains tax on the sale of shares. So you can bring in new shareholders, sell your shares without any tax necessarily on the sale of those shares. There are other considerations to meet around shareholder continuity and making sure that we can carry forward any losses and carry forward any imputation credits. So it is worth a conversation if you are looking to change your shareholding.
So a very common structure that we use in New Zealand is a dual company structure, and a lot of people have some questions around how does a single company structure versus a dual company structure work, and why would we want one? So a single company is exactly what it sounds like, a single company. And then the dual company structure is what we have up on the slides at the moment. So that's where we have a holding company. That holding company does exactly what it says on the tin. It holds your assets. So it's often where you have all of your intellectual property, it's where you have cash. If you have anything else of value in your company, all of your assets, we typically sit them in the holding company. Then it owns the operating company. That operating company is where all of your client agreements, supplier agreements, your employees, all of those agreements are with the operating company. So if you were to experience risk, be it you've overextended and a supplier is coming to you and saying you're in breach of your agreement, I'm going to sue you. You mess up with your employees and your employees start coming after you. If your clients are coming after you, they have a claim against the operating company, which essentially doesn't hold anything. It's an empty shell. So it means that you are protecting your assets, and it is a much more robust structure to defend against claims. So a dual company, when you have really high values intellectual property. So, a really common one is for some of our software as a service providers or things like that. We then license that software down into the operating company so that the software itself is protected and the IP is protected. It's the same if you have anything that's registered with a patent or a trademark, anything along those lines, all will sit up there. So, from a risk perspective, lawyers love the dual operating structure. It does make things a little more complicated, so we don't do it unnecessarily if you're not going to be taking on a lot of risk in your business or if you're not going to have any assets to protect. Alrighty, shareholding vehicles. So the shares in your company, whether it's a single company or a holding company, you can hold it as an individual in your personal capacity. as a trust, which is an individual or corporate trustee, or a company. So there are legal benefits to each one of these, and it really depends on your personal circumstances as to where we're going to hold them. But generally speaking, we find it's a financial decision. So Alaina can talk a little bit about that.
Perfect. So I guess the biggest consideration here is for the working shareholders and how you get paid from this company that you're working in. So there's a couple of options there. Shareholder salary. So if you are a shareholder, you can receive your shareholder salary. So keep in mind to be able to receive the shareholder salary, you need to hold at least one share in the company. So when you're looking at how you structure the shareholding in your company, keep that in mind because if you're not a shareholder, you cannot receive a shareholder salary. The other option to get paid is be an employee of the company. So you can look at just put it through payroll, pay as you earn, and you'll just be a normal employee under normal employment law rules will apply to that. And keeping in mind, yeah, where do you want the profits to go? What is your plan for them? If you are wanting to take that money out of the company, you need a vehicle to be able to take that out. So if your shares are owned by another company, you're going to have to do a dividend from one company to the holding company and then out to the shareholders. You can't skip the share where the shares are held. It has to go full circle. And personal services income. So this is a big one for anyone who is in the industry of providing personal services, accountancy, legal, health, architectures, that kind of thing. So, if you are in one of those industries, if you are earning 80% of your income from one source and you are doing all the work, then it doesn't matter if the business is run through a company, all that profit has to be allocated out to the shareholder who is doing the work. So, this has come about because people would try and avoid that highest tax rate, start to operate through a company, and pay themselves a lower salary than they were receiving via PAYE, trying to avoid that 39% tax rate and pay the company's 28% tax rate instead. So unfortunately, there's rules around all of that now, and it can't be avoided. So keep that in mind when you're setting it up, that it might not necessarily have the tax saving that you are looking for. So have a conversation before you go ahead and set it up and overcomplicate things unnecessarily.
That's a great point. Um, and just speaking to holding the shares in a trust, obviously, a lot of our clients would like to hold all of their shares in the trust because it is protected from their personal financial liability. And we often see companies
Yes.
in New Zealand being set up with one share in a personal name and then the rest of the shares in the trust. Can you just explain why that might be?
Yes, that is the most common way to do it if you are wanting it in a trust, and it's literally just so you can do that shareholder salary. So we just need 1%, just one share as an individual, which means we have the freedom to allocate that income out to the shareholders, um, and look at the best tax outcome as for the client as a whole. So we want as much of the asset protected for the trust as we can, and just that 1% allocated to the individual so that you do have that freedom to allocate as you want to.
And avoid that nasty trust tax rate.
Yes.
All right. Discretionary trust as shareholders, which is just talking a little bit more along that. So, the benefits of a discretionary trust, which come up in every conversation that we ever have with anybody who's establishing a
Mhm.
company, is do I need a trust? Why would I need a trust? Now, that's a whole webinar on its own. So, I'm not going to get too deep into trusts and why not. And hopefully, you'll be able to have those conversations with your own advisors if you're at that stage in your business, or you've already had a very detailed conversation if you're already established. But the largest reason is for asset protection from creditors because the trust is a separate legal entity. If you, as a director in your role, are held personally liable for something that has happened and your creditors are pursuing you, or you've provided a personal guarantee as part of your business, which is very normal. Often, your lender or some major suppliers will require you to personally guarantee the contracts that the company is entering into. You will take on personal risk, which means that if you were to experience a loss there, it could come back and hit you at home. So, a lot of times people will try and hold their shares in a trust. And that means that should there be a liquidity scale event, then you will join the list of creditors because you are a shareholder of the company. There's that flexibility in distributing the income and capital that we've just talked about with Alaina, where then there'll be a little bit more to chat about there, and flexible for tax planning, which I will let her take care of. And then there's the fact that the beneficiaries of that trust are generally not liable for the trust debts from a legal perspective, which is quite nice. But I'll let Alaina talk about that a little more thoroughly.
Perfect. So again, yeah, it's just the flexibility on what we do with the tax around for a trust. So the trust tax rate is 39%. Obviously, we try and avoid that as much as possible. So with a trust, you've got a lot of freedom on where you allocate that out to beneficiaries. Um, Except for minor beneficiaries, if they're under 16, we're limited to $1,000 a year. But for anybody else who is a beneficiary of that trust, we can allocate the taxable income out and they can pay tax at that marginal tax rate, which if they're under 180,000 a year means you can avoid that 39% tax rate altogether, which we like to do. And yeah, beneficiaries, I think, not being liable for trust debts, as long as there's no loans overdrawn beneficiary accounts, that sort of thing from a tax perspective, they're generally safe.
Yep. And that's also if you have your lawyer harping on about you about trust documentation and during annual meetings and all those sorts of things, and why you feel like you probably sign 1,000 trust documents every time you touch something to do with your shareholding. It's for that reason. It's to make sure that those trust debts are all squared away so that if an event happens, you don't have someone like Alaina saying, well, you didn't stay on top of it. So actually, there's something there that we need to talk about, which is the last thing you need when you've tried to set something up for protection purposes. All right, restructuring your business after a launch. This is something that quite a few of you were interested in. So it's very common in New Zealand. You launch as a sole trader if you're bootstrapping your business, if you're starting out small and you're trying to just test the waters and see how it goes, and it has scaled. And you go, actually, I think I need to move myself into a company. How hard is this? Now, from a legal perspective, moving from a sole trader to a company isn't too hard at all. It's very straightforward. But moving from a single to a dual company, that gets a little more complicated. So from the start, going from a sole trader to a company, really great idea if you've decided that this is going to be a big part of your life and a big financial part of your life. You get the benefit of limited liability, so the company can help protect you personally, and your personal assets experience a degree of protection. And how well that protection works depends on how well you've set it up with your lawyer. So make sure you have a really thorough conversation at the start to know what sort of blend you need between a company and a trust, to maximize your protection if that's what you're looking for. There's a lot more flexibility from a legal perspective on bringing in business partners and investors. There's a lot of different ways that we can look at capital raising. There's lots of different ways that we can look at splitting up your business in terms of ownership, which will help accurately reflect your risk as well as sort of the effort that's being involved. And there's that credibility part that we spoke to in the first slide, that it does help you a lot with your commercial conversations if you are a incorporated company instead of just being Joe Blogs out there in his sleeves. But there's quite a significant difference, obviously, in the tax treatment of these different structures. So, Alaina, over to you.
So the first thing is just to keep in mind balance date and when you make this change. So if you make the change midway through the financial year, you're going to have financial statements and tax return to do for your sole trader business. And then you're also in the same year going to have part year accounts for your company and tax return due for them as well. So where we can, I would recommend making the change on your balance date so that you've got a clean cut 2025 financial year, you're a sole trader, 2026 financial year, you're operating as a company. Having that nice clean date, nice clean split makes things so much easier from a compliance point of view and also saves you from paying for things twice in one year. Keep in mind GST applications. So anything that you're moving from your sole trader to your new company has to be done at market value. So transfer of assets, they have to be transferred at market value. Any vehicles that you have, you'll need a valuation for those to transfer those over. Um, GST, you could pay for GST on your sole trader when you sell it and then claim it in the company. Just make sure that when you set that company up, that you're registering for GST at the same time, so you've got a nice clean split when you do transfer them over. You want to be able to pay in one and claim in the other, or have a chat to your lawyer about drawing up an actual sale of business agreement, and we can zero rate that transaction for GST, if you have that agreement in place.
Ready. So the single company to dual company, when there's a shift in this from a legal perspective, it can get a little messy, mostly because your original company is probably going to stay as your operating company. So you're probably going to establish a new company that will be your holding company, which means we're going to be moving your assets from your holding company from your operating company to your holding company, and then licensing them back or putting whatever needs to be in place between the two there. So when we do that from a legal perspective, there's quite a lot of documentation. And if you have taken on a significant number of shareholders in your first single company, then we have to deal with all of them as well, because depending on your shareholders agreement, there may be some hoops to jump through. So definitely, if you think that you're going to hold a lot of assets, you should always think about starting out in the dual company, because moving from the single to dual is not a straightforward process. It does involve quite a lot of legal documentation, and there's some financial considerations that can be a little painful from time to time to navigate. Thankfully, we have people like Alaina to do that. So, could you talk us through some of those, Alaina?
Cool, perfect. I think the main thing here is just to make sure that everything is done at market value. So all those assets have to be transferred over at their market value. So getting a valuation is key here. And then when you're licensing it back from the holding company to the operating company, again, that license has to be has to take place at market value. So you need to be able to justify that. And if ID do come knocking, you need to be able to just have that valuation in place, make sure that you can prove that you are charging market rate for those things.
Yeah. And definitely, I think the shareholders tend to, if you've taken on a lot of shareholders in that single operating company, everybody wants to make sure that every T is crossed and every I is dotted, because everybody is really invested in making sure that they're maximizing their returns. And
Absolutely.
that can be a real big problem. Alrighty, restructuring after a launch being the sale and purchase of shares, business assets, and the issue of new shares. So, selling the shares versus selling a business is really a risk-based decision or a practicality-based decision. So it can be quite nuanced legally as to which one we're going to prefer. Sometimes financials will be the tipping point into making that decision, because when it comes from to a legal perspective, almost always we're going to go, we want to sell the business. We want to sell the whole thing. We don't want to sell just the shares, unless we're looking at a partial disposal, I suppose. But if we're getting rid of the whole thing, We often want to get rid of all of it all at once. And selling just the shares over has some legal risk things that need to be tied off to make sure that even though you are no longer part of the business because you have disposed of 100% of your shares, that you are protected from future claims because you are no longer associated with it if those claims arise after your date of departure. And it's the same when it comes to assets. It's all about making sure that you're protecting yourself post sale. So I'll get Alaina to talk about why it is that we actually have to consider sometimes selling the shares instead of just the whole business.
So it is easier to sell the shares, and especially if you're not going to sell the whole thing. If you just want to bring on another investor, obviously you'd have to sell the shares for that to happen. There's no capital gains, no tax when you sell the shares. So from that perspective, it is nice and easy. But like Rebecca said, it does come with a lot of risk. You're responsible for everything, and that if you purchase the shares of a company, all that history is now yours. So if I do decide to do an audit for the last 7 years, that is now on the new shareholders to deal with, which yeah, it's not necessarily fair when you haven't been involved with any of those decisions. So the other option, of course, is selling the business. If it's GST to GST registered people, there's no GST elements. It's all CR rated, but there could be tax consequences from that. So from the company who's selling that business, or the fixed assets will be sold. So you'll have to think about depreciation recovered on any of your plant, property, and equipment. Have you got your stock valued? That will come through as a trading sale. So tax consequences to consider with that. Um, and then when we are selling shares or doing a shareholding change, even within family members, we need to keep in mind your shareholder continuity. So if you're wanting to bring in a trust to own some shares, or bring in your children or family friends, whatever it is that you decide to do, there are tax consequences if you lose some of that shareholder continuity. So the imputation credits, to maintain imputation credits, you have to maintain 60% shareholder continuity. That means 60% of the shares in that company cannot change hands without risking losing those imputation credits. And that's 28% of the retained profits that the company's made. So they transfer to the shareholder on when we do dividends. So you don't want to lose those, because you'll be basically paying another 28% on all profits that that company's made unnecessarily. So it can be very costly if those are lost. And then if your company is in a loss situation where it's carrying forward losses, 49% shareholder continuity has to be maintained to be able to continue carrying forward those losses. They did bring in a business continuity test to that a few years ago, so there is some hope, and be able to satisfied that test, you just need to be able to continue with the business for the next 5 years without any material changes to your industry or to the business. Yeah, so have a chat before you make any shareholding changes. I guess is my big thing there.
Yeah. Shareholding changes should always be navigated really carefully. And as Elena said,
Absolutely.
it's lovely when we can dispose of the shares instead of having to sell the whole business. But it's such a nuanced conversation about risk. Who are you buying from? Who are you selling to? What's the risk associated with the business's history as well as its future? And what are we talking about in terms of tax losses? Because it's really going to change for every single business in New Zealand, depending on what their activity has been. So, making sure that you have that initial consultation before diving into something and promising anyone anything is fairly essential. All right, so that concludes our main talking points for today. You might find our download of our startup manual in New Zealand helpful. It does cover off on quite a few of these topics and goes into a little bit more depth around each entity, and things that you might want to consider before having a chat with a lawyer or an accountant and getting yourself underway. You also might be interested in our next webinar that we have coming up, which is mitigating your business's health and safety risks with NZSIM. So that one's going to be on Tuesday, 19th of August at lunchtime as well, to try and make sure we're catching those of you who are just taking a quick break and decide that a webinar is your fun way to relax. And then the other thing to have a chat about is that if we're going to get to your questions in just a moment, but while you submit them, I'll just talk to you about LegalVision's membership, which is obviously where I am from. So by becoming a LegalVision member, you essentially get access to over 100 specialist lawyers, which is like having your own in-house counsel. We can assist you with unlimited document reviews, advice consultations. We've got unlimited domestic trademark applications included under your membership. We have very quick turnarounds because we have quite a substantial team who's able to assist. And it's really affordable because it is not like a traditional legal fee where you have no idea what it's going to cost you at the end of the day. We have a fixed monthly fee that's coming out, and so you can really predict those operating costs, which if you're scaling quickly, very important. Um, as a Legal Vision member, you just have to think about us as your in-house counsel, which takes the pressure off. And definitely you can afford that much sooner than you could of just hiring a single full-time in-house lawyer. To learn more about how our membership or desk extension could help you, request a free consultation when the survey appears at the end of the webinar. And obviously, this is my lovely co host, Alaina, who's at Beanie. We've got her information up here on the screen. If you want to learn anything more about Beanie, you can scan the QR code to visit Beanie's website. Alrighty, we can get, oh, thank you for the hands. We can get into some of the questions that have been sent in already. So one of them was, if a company starts with two individuals as the directors and shareholders, is it a simple process to later introduce ownership via a trust or dual company arrangement? So yeah, we've talked a little bit about this today, that from a legal perspective, if we're going to be moving into a dual company arrangement, it really depends on the assets involved as to how many assets we're moving. But in general, it's something that we can fairly practically look at. And if those assets are of substantial value, then it's a worthwhile exercise to go through. And then introducing a trust as a shareholder instead of yourself personally is generally a fairly straightforward legal process as well. But as Alaina's mentioned, and you might have some things to add here, Alaina, there is some financial implications to it. So things like timing are really relevant. Is there anything you wanted to add to that one, Alaina?
I just keep in mind the shareholder continuity there when you are making those changes. So, just have a chat about how many shares you do want to transfer, and we can see and let you know what the implications are for that. It's still possible. We just need to maybe declare a dividend or something like that before we make the shareholding change.
Yeah, cool. We've got a question from Katie. Can you provide an example of what level of business or other considerations you would move from a dual company structure to a trust? Seems like the holding co already offers asset protection and the tax rate is lower. Okay, so from a legal perspective, usually it's when we're in a dual company structure, I would still expect that in the operating company, your shares might be owned in your personal names instead of by a trust. So if we're talking about where those shares are being held in that opco, the opco still takes on risk, and the holdco is protecting the assets of your company. When the trust owns your shares, it is protecting you and any residual value that you might have in the opco, and same in the holdco. So by having that, it means that if anything travels through to you as director, if you become personally liable for any reason, and there are a number of reasons that you can become personally liable for the financial burdens of your company, then those shares are then held by a separate entity that's not you. So, in the absolute worst case scenario, if I was to be the doomsday sayer, that you had a liquidity scale event and then you yourself were held personally liable and you ended up declaring bankruptcy because there was absolutely no way you could meet that debt yourself, then in theory, if it's all set up correctly, those shares that are being held by your trust are a separate legal entity and should not be gathered together during that process. And so they are held separate and they could continue to be held separate. And the value that you derive from them as the secured creditor would be held separate. And so you could work at rebuilding your life and rebuilding your personal financial stability while those were being held in a separate legal vehicle. So there is, generally speaking, a degree there that you look at as to how risky is the business and how valuable is the business, and as to whether or not you're going to have that trust. And do you already have the trust anyway for another reason? Because if you already do, legally, might as well. You're not going to be doing too much worse. But Alaina, you might have something to add there financially.
No, I think that's perfect. I think you've covered everything from my side as well.
Oh, thank you. Sorry.
No.
Um, Alrighty. Is there a way to provide first employee equity without the tax implications of the the ESOP, the employee share plan? So I'll leave that one to you, Elena.
Yeah, cool, perfect. Um, Generally, no, unfortunately. No, that's not probably what we want to hear. But as soon as those shares are vested, if an employee is receiving shares at less than market value, then that is going to create a tax implication for that employee. There are things you can do around timing. So you could provide them units in the company that transfer to shares at a later date once certain criteria have met. For example, once they've been an employee for a certain amount of years or something like that is quite common. But as soon as they're vested, then unfortunately it is a tax implication on any shares sold or transferred at less than market value.
Cool. Um, the next one is definitely a new question to Elena. Can I profit shift to a tax haven in the Bahamas like Apple does and pay 4% corporate tax? I want to know this one too.
I wish. No, unfortunately not. There's been a lot of international tax reforms in the last few years, and they've been put in place specifically to stop that sort of thing from happening. So, in today's world, that's unfortunately not possible. The OECD's put in a lot of laws in place, and 140 countries are involved in those laws now, and including the Bahamas. So they've stopped that from us. And I'll just add the structure that Apple had was very complex. Obviously, they trade internationally, so you need to have a commercial reason to be able to have profits in another country. You need to be operating in that country. You need to be able to justify it. Say their legal bills and their compliance bills would far outweigh what the general normal business within New Zealand would be able to afford to make it worthwhile.
Yeah. And their ability to have a legal team that's just fending off regulators everywhere would be
Absolutely.
wild.
Yeah.
Um, so we've got to wrap up in about 2 minutes. So I'll just blast through the last two questions. And if we haven't answered them in enough detail for you, then please feel free to submit for a consultation at the end. And we can obviously get into it into a little bit more. I don't want to make you feel like you've been cheated on an answer, but I'm also very mindful of everybody's time frames today. So there was someone that says they have a small startup, but a lot of people want to partner with them as shareholders. How do you divide the shares? 100 isn't enough. So the very short answer to that is absolutely. A company can issue as many shares as it wants when it starts out. You can do that up to, thousands, whatever you like, a number that can be as wild and wonderful
Mhm.
as you want. However, it's really important to make sure that you're adequately managing that process. And if you have already started, that you're not over diluting your own shareholding as you go through that process. You need to make sure that it's in alignment with your constitution and your shareholders agreement as well, so that you're not going to be breaching that. Your accountant or lawyer will be able to help you through that process and make sure that you are not doing something you're unexpectedly not going to be. If you have already started and you have some other shareholders already, then that's a slightly more nuanced process. So it's better to think about it at the start before you head out into the world than try and do it later once you've already got a series of shareholders on board. Um, I see that we've got Alan, Joshua, and James. You've all sent through really great questions that I would really like to answer, but unfortunately, we're out of time today. If you would like to submit your details at the end, and whether it's Alaina or I, will be able to get back to you on those ones. Thank you so much for your time and for sending those through. It's been lovely spending lunchtime with you today, and hopefully, we'll get to work with some of you in the future. And thank you to my co host, Alaina. I couldn't do it without you.
Thanks for having me. Great.
Thanks.